Hi, I'm Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and today I'm joined by Gareth Abley, Head of Alternative Investments at MLC. Welcome, Gareth.
Hi, Sinead.
Gareth, what role do alternative assets play in the MLC portfolios?
Alternative strategies are essentially there to do two things for our investors. Firstly, they're there to provide very attractive risk-adjusted returns in their own right. Secondly, and equally as importantly, they're there to provide excellent diversification. So when other assets in our portfolios like equities and bonds are potentially struggling, our portfolios are looking to be completely independent of those drivers and hopefully deliver positive returns even when equity markets in particular are not. Short-term diversification matters, long-term diversification matters as well. So what we mean by that is if we get a very long period when equities don't deliver, as Japan has experienced over the last 30 years, then it's really important for investors to have something in their portfolio that can deliver attractive positive returns. And that's particularly acute today because bond yields, which are the traditional diversifier, are very, very low and unlikely to provide attractive returns and questionable whether they'll provide diversification benefits.
MLC have held alternative investments in our portfolios for quite some time now. Can you tell us a little bit about the evolution of those strategies over time?
We first invested back in 2007 in two pretty interesting strategies, one of which was Bridgewater Pure Alpha, a global macro hedge fund, and the other was natural catastrophe reinsurance. Since then, we've evolved the portfolio to have around about a dozen different strategies in there, ranging from systematic market neutral strategies to more eclectic litigation-based strategies. So the goal is to have individual strategies that are all uncorrelated to equities, and they're also all uncorrelated to each other. And through that, you can provide a very steady and attractive return stream through time.
So you mentioned Bridgewater being one of those strategies. Can you tell us a little bit more about them and what they do and how they do it?
Bridgewater are a manager we know pretty well, so we've invested with them since the early 1990s in various mandates, and we invested in their global macro hedge fund back in 2007. What a global macro hedge fund does is it has the ability to go both long or short any asset class. So if they think equities are going up, they can go long equities. If they think equities are going down, they'll go short equities and profit from the downward move in equities. They can do that across fixed income, they can do that across currencies, they can do that across commodities. So they have a big palette of opportunities with which to express their views on what's happening in markets and lots of different ways to make money in a diversified way. So that's what they do in a generic sense as a global macro manager. What we think makes Bridgewater quite unique is their culture. So they have a very, what we would call, unique and sharp culture that's based around what they describe as radical truth and radical transparency, which in some ways boils down to providing extremely firm and rapid feedback to each other on what mistakes they're making, what they need to do better. And the goal of all that is to evolve as quickly as possible, and that recognises that markets are incredibly efficient. They get more efficient each year. And unless you apply significant resources and significant IP to that challenge, you will lag behind. And I think Bridgewater's culture forces them to continually evolve quicker than the opposition.
And Gareth, how has a low correlation strategy performed, particularly in the last quarter of 2018 when equity markets didn't?
It had a pretty good quarter. So I think with equity markets down, in some cases up to 10% in Q4, the low correlation strategy was up 2% net of all fees. Obviously that's pleasing for us and more importantly our clients to deliver when markets are struggling around the world. What was also pleasing for us was that I think 9 of the 13 strategies in the portfolio were positive in the quarter. So it wasn't driven by one manager getting lucky or hitting the ball out of the park. It was pretty broad based.
Thanks for your time, Gareth.
Yeah.
Thank you for joining us.